Minutes from the Monetary Policy Committee shows that Bank of England policymakers voted to keep interest rates low. I'm on the line now with Craig Erlam, market analyst with Alpari UK, to discuss these minutes and more. Welcome back, Craig. Now let's start off with the result. The Bank of England policymakers voted 7-2 to keep the key interest rate at a record low this month. What's your reaction to this?
Well, I think one thing that surprised people is that the minutes seem to go against what Mark Carney and the other policymakers said at the Bank of England inflation report last week. Last week, Mark Carney talked about the threat of lower inflation, the fact that expectations were for inflation to fall below 1%, meaning he'd have to write a letter to the Chancellor explaining why they'd fallen below the lower threshold for the Bank of England, and that inflation then wouldn't rise to 2% again for 3 years. So automatically people start thinking, well, maybe these minutes are going to be quite dovish, and maybe he could even see one of the two voters, if not both of these voters, despite being very well-known hawks, actually vote for no rate hikes. If inflation expectations are so low, then how can we be seriously discussing hiking interest rates? But then the minutes come out and they're a little bit more hawkish than we were expecting in both the commentary, but also the fact that these two voters remained in favour of a rate hike. So I think we're getting mixed messages from the Bank of England right now, and I think this is going to be a bit of a concern to the markets, because it's something which we seem to have moved away from in the past to a certain extent, with these central banks wanting to be more transparent and more clear in their messaging, because they want to avoid all this market volatility which comes as a result of confusing the markets. But then already we're seeing mixed messages when we're talking about the exit plan from all this quantitative easing and low interest rates.
The majority are now beginning to raise concerns about potential inflation pressure. What do you think are contributing to these pressures?
Well, again, I think this was quite surprising for the markets, just simply because of the expectations that Mark Carney had talked about last week. But I think it's also understandable to an extent to have these risks associated with the inflation to the upside as well. There's always two sides to a coin, and when you're talking about the risks of disinflation in the economy, there is always going to be risks of inflation rising as well. And I think this is going to be focused around this tighter labour market, which they were talking about. At the end of the day, unemployment has fallen quite dramatically over the last 12 months or so. And when you get to these lower levels of unemployment, or what other central banks such as the Fed deem full employment, this is when you start to see more competition for roles. It's when you start to see unit labour costs rising. It's when unit labour costs falling and productivity rising. And it's at this stage that we start to see more wage growth, and this is what we've waited so long for in the economy. And it's this increase in wage growth, and especially when it then overcomes the inflation levels, this is when we start to see more pressure to the upside on the inflation readings. And this is what the certain policymakers are afraid of at the moment. For me, this doesn't justify voting in favour of a rate hike or even seriously considering rate hikes, because at the moment we've seen absolutely no evidence of it. But this is what the policymakers are referring to when they're talking about the potential for higher wage pressures and inflation potentially overshooting that 2% target.
Now let's have a quick look ahead to the UK retail sales out tomorrow. What are you hoping to see from these results?
Well, I think what we want to see from all the UK economic data right now is just, at the very least, some form of stability, because we've seen so much improvement over the last 12 to 18 months. We are seeing an economy now which is very much on the mend. We've seen good growth figures. We've seen falling unemployment. We've seen quite a spread economic recovery as well across all different sectors. So I think we've got to be pleased with what we've seen. But the consumer is so important to the UK economy. Consumer spending makes up around 2/3 of UK total output. So things like retail sales figures are extremely important to the UK economy, and therefore, at the very least, we need to see these stabilising. And this is what we're expecting for tomorrow. We're forecasting 3.8% year-on-year increase in retail sales, which I think is quite strong. We have seen a slight pullback over the last few months, but I think a 3.8% figure will show that we're starting to see some stability in these retail sales, this constant growth, these type of levels which are consistent with seeing 2.5% to 3% growth in the economy. But also we've got to remember as well, we're approaching the holiday period, and the holidaying period is so important to an economy like the UK. We need to see strong consumer sentiment. We need to see strong consumer spending in order to really support the economy in the final quarter of the year. And what we've seen in the last couple of years is actually sales coming in earlier because consumer sentiment's been low, and therefore retailers have had to drop their prices and bring the sales in earlier in December or even in November in order to actually make sure they shift the stock. So it's going to be interesting to see what we see over the next couple of months. But as long as we see some stability in October and some strong stability, like this 3.8% reading that we're expecting, then I think this gives us a good sign going into that really important holiday period.
Thanks, Craig. As always, it's been great to speak with you. That's all from me for now, but stay clicking on to Dukascopy TV, where there's plenty more interesting content and exclusive interviews to check out. Bye for now.